All right. I think we're just starting to broadcast now. We are a couple of minutes after 12:30 here. And before I introduce our guest speaker, I do want to just sort of mention who's on the call today, which is myself, Daniel Greer, and Megan as well is helping us out as far as hosting the Zoom call. And then of course we have our guest speaker, Christian Deckart from Mower. Now my goal for today is threefold. Number one, we want to provide you, our important clients, with insights from the brightest investment minds in Canada. Number two, we want to provide you with clarity on what is happening and what action is being taken, because within the funds you own, there's been a lot of rebalancing and new investments made, but you don't get to see that within the mutual fund structure. And finally, we want to be available and present to you, our clients, during this challenging time. So with that, I'll start off with, at the bottom of your screen, there's a chat option with Zoom. If you have any questions for myself or Christian, please put them in there, and myself or Daniel will ask them on your behalf. Now, before I pass things over to Christian, who's going to talk about Mower's consistent long-term process, which has been successfully building wealth for Canadians since, by the way, before I was born, I did want to share a story with you. In our first webinar, I talked about my first stock trade that I bought, MyTech, back in 1998, which was a tech startup, and it was a successful investment, which got me very excited about the investment business. Today, I want to talk to you about another investment I made, but this time it was a complete failure. Now, they say you learn more from your mistakes than your wins, so let me share my story. After my successful short-term trading of some tech stocks and thinking that I was quite the whiz, I thought I'd jump into another short-term trade, which was gold. In the late 90s, gold was trading at historical lows of around $300 per ounce. So I thought what I would do is profit off of this, because I would buy at a low, and of course gold at some point was going to rally. So I'd get into some research penny stocks that specialized in gold. This one was actually called Greenstone Resources. Well, I got in and took a position at somewhere around $2 a share. Again, this is around 98, 99. And although I was incorrect, gold didn't rally for another 2 years. Even when gold did start to rally, Greenstone kept going down and down and down. And eventually to the point actually where it was delisted and worth zero in 2010. What I didn't understand, number one, was that there's a big difference between making a commodity trade and owning a business that happens to sell that commodity. But the bigger lesson was the fact that the short-term trendy ideas are not investing, and it is speculating. Which brings us to Mower. For over 45 years, Mower has been providing investment management for their clients, and their motto is "Be boring, make money." Today on our call, we have the Deputy Chief Investment Officer and Portfolio Manager for Global Equities, Christian Deckart. Today, he's going to share with us their investment process, a little bit of their history, and how they are well positioned in the current market to make money in a very boring fashion. Christian.
Thank you. I can't resist starting with a quote from Mark Twain now on your story. A mine is a hole in the ground with a liar on top. More, it just has to do with your gold mining story. So good, boring, make money. We can jump to the next slide. I'll quickly take you who we are, what we do, and why that's led to the results it has. So Jon is younger, but we were founded in 1974 by the gentleman here, Chuck Moore. Was the time of the first oil boom in Alberta. So there were a lot newly rich people. And that's really the basis how the company was founded more than 40 years ago. And while the motto today is be boring, make money, the unofficial motto in the beginning of the firm was our clients are rich already. Let's just not make them poor. And the idea is, yeah, we try to beat markets. Yeah, we try to be better than the indices. We try to add value, but also do that at below average risk. And I think a lot of questions people have around more, if you go back, like why do we do things the way we do? Well, it comes back to that. We try to beat the market and do that at below average risk. One important ingredient, in our opinion, is the independence of our firm. So, you know, we have no headquarter in London, Boston, or New York to trick. It's just us and our clients. A group of employees, we're now roughly 60, own the firm. So it's just us, our clients, no outside influence over what we do. AUM currently around 60 billion Canadian dollar. And we only follow one investment philosophy wherever we invest in the world, which I'll talk about in a second. But following just one investment philosophy has the advantage that we all can learn together. So we're 30 people in research, and if we all work on the same problem, then we can learn from each other and help each other out. Well, if we had a value desk or a growth desk or a restructurings desk, well, there would be very little, how shall I say, intellectual learning overlap between what we do. But here we're 30 people working on the same problem. We are different. It all starts with the people. So what sets us apart? The idea 25 years ago when Jim, our current chairman, sort of built the research department was, well, a lot of smart people try to beat markets and do that at below average risk. If we do what everyone else does and do it the same way as everyone else does it, it's unlikely that we're going to get results that are different and better from everyone else. So it all started with the people, and we've tried to put together a group of intellectually diverse people. So we speak 12 different first languages. I'm German, in case you haven't noticed so far. We come from 11 different countries, and we have different educational backgrounds. I have a PhD in German law, but we have someone with a PhD in neuroscience, someone with engineering degrees, or several people with engineering degrees, actually. So let me start why we do that. So the educational backgrounds are pretty easy. Most people try to beat the market by taking tools and ways of thinking that are only from finance and business administration. And while these tools are helpful, it is helpful to have other ways of thinking, other ways of solving problems. So that's why we think the educational backgrounds are important for diversity of thought. The different countries, well, we're global investors. Today, 2/3 of the assets we manage are outside Canada. And so it does help to have people that have, most of us are from different countries. So that we've come from other places, seen other places. That makes global investing easier in our opinion. And then the different languages. Well, last year we interviewed more than 1,100 management teams from around the world. And often we can have these interviews in the language that the managers speak. And of course, when they speak their own language, then they're going to say a little bit more. They're going to be a bit more comfortable. They can give a little bit more detail. So we think that's another advantage. If we move to the next slide. And so I mentioned, hey, we have come from these different places, speak these different languages, have these different backgrounds. But of course, we need something to tie it all together and to make us work together. And so we've worked very hard on our culture. Culture is sort of a current buzzword and everyone talks about it. We have worked with a consultant, focused consulting group out of Chicago that specializes in consulting to asset management firms only on culture. So very specialized asset management firms and on their culture. And we've worked with these people for more than 20 years. Actually, if you read their book, which I highly recommend because it's a great book called High Performing Investment Teams, they will mention how they helped resolve a succession issue at a Calgary-based asset management firm sometimes in the late 90s. So that is when we started working with them. So there you have sort of written proof that you can buy on Amazon that we've worked with these people for a long period of time. We also think our work in culture shows in the employee retention ratio. So in research over the last 10 years, we had an annual employee retention ratio of more than 95%. Why is that important? Well, if we want to beat the market, we've got to learn, and we've got to learn together. What we call play intellectual best ball, like in golf. We take ideas and someone develops it, someone else takes it further. And for that, it's really helpful if you work with the same people over a longer period of time. You know each other, you trust each other. It's feedback we got from a former investment consultant of one of the big consulting firms. She joined us recently and works for us now. And she said, like, yeah, when she was on the consultant side, so consulting to the large institutional clients, they sort of knew that our culture was special, but she had no idea until she joined. So I don't know how we get that better across, but I can tell you, like, one of the big differentiators here sets us apart is culture. I can tell you, I was over here for a week 7 or 8 years ago during the interview process. It took a week, so I went skiing with a few people and just spent a lot of time with each other. And I thought the culture was so good that I even moved to Calgary for that. So that's a bit of proof, if you will. Now, this is the investment philosophy. We try to be good owners of good businesses for the long run. These are fancy words here: wealth creating companies, excellent management teams, bought at discount to their intrinsic value. Really, it comes down to good business, good management, good price. And we have not invented that philosophy. That's the philosophy that, Berkshire Hathaway, Warren Buffett, Charlie Munger have popularized over the last 50, 60 years. Most people know it. We don't think this is where our edge comes from. We think this is a very sensible strategy. It's a common sense strategy, but our edge really comes from applying it consistently and from the cultural aspects I've mentioned before. Why do I say it's a common sense strategy? Because think of the opposite, right? Buying bad businesses with bad management teams at too high a price, like that's just absurd. So that's why we say it's a common sense investment strategy. It's a good ingredient, but it's not a sufficient ingredient. We think it's the culture and the learning attitude we have. Now, you may wonder why you see that cream there, and this brings us to Jon and his age. So Jon has fluked you a little bit here. He's 68. And the reason why it doesn't appear like that is because he puts this nice cream in his face every day, every morning. Spends $80 in the store and puts that anti-aging cream. And as you can see here, it works. And for those that are invested in the global equity fund, well, you benefit each time that Jon buys a new jar of that cream. So Jon might buy that from L'Oreal for $80. But the active ingredient, so that has the great anti-age effect that you see on screen here, the ingredient in that jar is maybe only 10 or 20 cents. And it's a company called Croda that produces these active ingredients. By the way, not just active ingredients for anti-aging cream, but for all sorts of creams. Sunscreen is the other example. Like in a sunscreen, it's similar. The whole box you pay, the whole bottle you pay is expensive, but the input that actually does the anti-sun, that protects you from the sun, is maybe 10 or 20 cents. So when you think of that, when Croda negotiates about prices with L'Oreal for these active ingredients, well, Croda is in a great position because sort of their ingredient is designed into the product. It has all the effect and it costs very little. So they have what's called pricing power. That's why Croda has high returns on capital that are protected by a competitive advantage. And that's just an example of a wealth creating company.
Where's Croda based out of? Just out of curiosity.
They are based out of, that's a great question, because they're based out of the UK, but most of their business, like it's a global business. Effectively, the anti-aging cream that I take as well, by the way, is sold around the world, right? By L'Oreal or Nivea or whatever the brands are. So they're UK based, but yeah, I think more than 90% of their business is outside the UK. If we move to the next slide, yeah, we can jump over that. That's just that leads us a bit too far in the details. So I've mentioned we do management interviews to get a sense of how good the company is. We try to talk to customers, competitors, suppliers. We do forensic accounting because we don't trust audited numbers. We try to go deeper and look for long-term correlations, cash flow statements, balance sheets, income statements, and so on. And we look at ESG factors. And once we've done all that, we put up a report. And when we have the report, we have a pretty good idea where a company stands on what we call the matrix. Now, if you look at the horizontal axis, that's the return potential. 1 is the best, 4 is the worst. Thanks. And the quality axis, is from A is the best and D is the worst. Quality is made up of quality of management, quality of business model, and the riskiness, and the return potential is the outcome of our calculations that we do. The goal, of course, would be to buy the best companies at the best valuation. So A1s, best companies at the best valuations, yeah, up there. But you see there's no company there. So capital markets aren't totally inefficient. So usually you don't get the best quality companies at the cheapest valuations. So usually you have to find some sort of marketing always tells me don't say compromise, say balance. So a balance between the quality you can achieve and the return potential you get. But in reality, it is sort of a compromise. But you see the different shades of blue. And the further we get to that best company at the best price, the A1, the higher our guideline weight would be, right? When it's not that great, a bit further to the left and lower left, then we would make it a 2 to 4% position, below 0 to 2, and then there's a cutoff where we just don't touch it. It doesn't have the quality we want to give to our clients.
So these are actually weightings of the individual stocks in the portfolio. You have
these are guideline weights. Yeah, we don't follow them mechanically. Like this is human judgment, but this is sort of the start of a discussion. And if you just point between 1 and 2 and around B and C, yeah, you see BMW. Yeah, here. Yeah, there, BMW. So I'm from Munich, so I'll use BMW. We held that in portfolios a few years ago. We sold that. And so I'll just use BMW here to explain to you why it's there. So BMW was a pretty cheap stock. So you see it's close to a 1. But in terms of quality, it's really middle of the pack. Why is that? Well, it has an outstandingly good management teams. I think they're probably one of the best, if not the best in the industry. The business model of building cars and then leasing them out is sort of medium, and then it has its risks. We were concerned about consumption in China at the time. We were concerned about the shift to electric vehicles. So this is where we rank it. But given that it has that good return potential, significantly above average, it sort of, according to the matrix, it deserves a 2 to 4% weight. Of course, the matrix changes all the time. When a stock goes up, let's assume BMW without news jumps by 20% in a day. Well, then it would move to the left on the matrix because its future return potential has just declined. And then our guideline weight would be lower. So this is really the tool we use to manage portfolios on a daily basis. I'm not sure if are there performance slides coming, John?
Yes, we have the global equity performance slide. Yeah.
Great. So maybe I'll quickly talk to that.
Here we go.
That's good. So, performance is what it is. You see here how it's done against the category. We would certainly look at the 10-year number. That's a meaningful time horizon in our view. In the short run, capital markets can be crazy and almost anything can happen. But here you see there's a sort of called a 5% outperformance on annualized on the 10 years. Where do we think that outperformance comes from? Well, we think it comes from everything I've talked about now. It's a common sense investment philosophy that we haven't invented, but we think it's a pretty good one. And then where's our advantage against other people that apply that philosophy? Well, we think it's in our culture, in our way of working together, having put together a very intellectually diverse team with people from different parts of the world that work together on one common culture. I also think it has to do with our focus on risk management. I mentioned we come from the private client business some 45 years ago, but that's still in our DNA. Our clients are rich already. Let's just not make them poor. I think that goes a long way in explaining the results. And of course, we're owners in the business, right? So we're not some big financial institution where next year the people you deal with might be totally different from the people you dealt with last year. Because we're owners. We have nowhere else to go. Like the headhunter calls us, that's a pointless call because we own our own business. Where would we go? I think that also, that long-term focus, the fact that we're all stuck here, happily stuck, I should add, that I think changes, makes a big difference.
Christian, for me, one of the big things that stand out about Mower and in particular the global equity, I've been using it for more than 10 years now, is even if we look at the 1 year number where the category average is down, over 8% and you guys are pretty much flat, really is the downside protection that your portfolio and seems to consistently deliver as far as not catching the markets when they're going negative. Very little downside participation there, yet strong upside. Are there certain things that you believe attribute to that from an overall portfolio perspective, or is it just simply the names that you're investing in have more resilience when the markets go down?
Yeah, our philosophy is always to, the sentence we say a lot here is don't fix your ship in a hurricane. Your ship should always be in ship shape. So often we get these questions right now. Oh, so what did you do in terms of cutting risk in the portfolio after coronavirus? And we were like, well, we haven't taken any outsized, in our opinion at least, we haven't taken any outsized or crazy risks before. So, we don't need to fix our ship when there's a storm, because our ship is always in ship shape. We are very conscious about risks. I just want to caution that the last 10 years have been exceptionally good for us. We think, we think everything we do has merit and should beat markets. Sometimes we feel like, the consistency in which we've done it in the past, there may have also been just coincidence in that. Like the way we run our funds, the portfolios in the business is not that we, think short-term and try to beat the market in all circumstances. It just happened, to happen that way. But I would always caution that no, any good investment strategy will have some relative underperformance from some time. And I think a great example is if you just go back and look in the annual report of Berkshire Hathaway. I'm not sure if they still have it in there, but 10 years ago they added. They showed how they did annually against the S&P back to the 1950s or 60s. And you're going to see, even when they were small and really great investors, like I think in 20 or 25% of the time, they underperformed, right? They really made it up on the years they outperformed. But it is normal that any sensible long-term strategy will underperform in the short run. So to summarize that, I think, it's worked great. I think the focus on risk management has helped us a lot. But I just wanted to caution there that may not, it may not always be that consistent. I think that's something we have to be upfront with clients. We'll surely do our best for that, but it's exceptional what's happened so far, and I wouldn't bank on that.
So as far as the you showed us the graph there, and you said it changes constantly. Obviously, with price valuation is going to have a big impact on that. So from December till now, with a very large fluctuation, did new names come up, or was it more weight changes with existing names?
It's been both. Like, if that's a good segue into that. Yeah, with the matrix, right? The whole coronavirus story has impacted the riskiness of some business models. So some companies have just moved on that axis. Some have moved actually up because in the current context with work from home, we don't own Zoom, right? But I presume the Zoom business model, if we had ranked it before, like that would have moved up, because all of a sudden that's a lot better business model than it looked like maybe just a few months ago. And then stock price fluctuations lead to a lot of changes on the horizontal axis. So that has led to changes in the portfolio, but also we have initiated quite a number of new names in the first quarter. And we have also eliminated a number of names in the first quarter where, we just re-looked at the riskiness in that coronavirus context. And, despite our focus on risk management, like, of course, that's nothing we had foreseen, coronavirus, right? And so all of a sudden there's this totally new risk that, parts of the economy shut down. And it's better to have resilient businesses when parts of the economy shut down. But still, there were some businesses that, when you look at how the world is playing out, they're just not, or were not that well placed, right, in the context of the matrix. So we did exit some businesses. A classic example is we did exit a few of our bank positions.
Okay.
Because
So
the lending
if
business is.
I'm just going to pull up the Manulife Global Equity top 10 holdings, if that's all right.
By the way, we also all use the cream.
Oh, it's my computer's freezing here when I'm pulling it over my other monitor. I see here Aon, as of the end of April, anyways, was your top holding. What do you find so attractive about Aon?
Well, Aon is an insurance broker and an HR consulting firm. So a lot of the revenue should be recurring. That's very attractive. This is an asset-light business. So, to run the business of an insurance broker or an HR consultant, you don't need to buy big machines or factories, like to run the BMW plant, for instance. So that's an attractive feature because growth doesn't require any additional capital. Well managed. But it's the recurringness and the market position that we like most. Yeah.
And then I see Microsoft and JP Morgan Chase then are the other.
I doubt that is the end of April, actually. But
no, it would definitely be at least a quarter old.
Oh, sorry, holdings as of February 29th.
That's not so bad, yeah.
Okay. Microsoft is there. As I said before, we all use Teams, but we've been invested in Microsoft before, so that's also recurring. That's recurring revenue. We pay our license fees. The more people also work on their phones now, the more licenses they need, because you need all of a sudden, you have your Office on your laptop, phone, or maybe on iPad. So that's good. Yeah, JP Morgan is one of the banks we own. Wolters Kluwer is a professional publishing business. So when you go to the doctor and they look up in their database what you might have, put in the symptoms, look what medication it could be. Very often it's a database for Wolters Kluwer where they do that. They also have legal databases. So it's workflow information tools. It's subscription. So also that is something, doctor is not that likely, in our opinion, to stop paying for their, for the database. By the way, not in global equity, but in global small cap, we own a company called Morningstar, which I think is an important tool for you guys. So these are just businesses we like because they're recurring subscription. They're very important for the people that use them, but actually in the grand scheme of things are not a huge cost. Well, then Alphabet is Google really. They're probably a bit more affected right now with ad revenues, but still a pretty good business. Visa is the payment cards, right? That network effect has some great growth drivers. McGraw-Hill Financial, that company is now called S&P Global. So this is the rating agency, S&P, and also, every time someone buys a product that has S&P 500 on it, even if it's a passive instrument, like S&P makes some money of that. Liquide is a French gas company, industrial gases, but also health gases. So at the margin, their business benefits from coronavirus, but that's really at the margin. But they also do, gases, oxygen for people. Intertek is a great business. It's a testing business in a world that's more and more globalized, where we do business with people, or in the supply chain, people do business with people they don't really know. And then you need some testing companies in between that certify that products are to a certain standard, to an industrial norm, stuff like that. Also increasingly on ESG standards, environmental, social, and governance standards. That's what Intertek does. Now, unfortunately, the last name. What was the last name? You want me to talk about that one as well?
Let me just see here. I can't quite.
Well, I've talked to 9 of the 10. It gives a sense of the type of business we invest in, right? A lot of knowledge businesses in that group.
And is that a general trend that you're moving more towards, are sort of service businesses, knowledge businesses versus, traditional manufacturing businesses?
Well, first of all, I think that's where the economy is going, sort of. I mean, us on the call here, in a way, we're all in the knowledge business. I think, manufacturing around the world is getting more and more automated or moving to emerging markets. So what's left in North America, Europe is knowledge businesses. So they also have the advantage that they're asset light, so they can easily or often they can generate high returns on capital, which is attractive from a shareholder basis. And they do actually lend themselves to quite strong competitive advantages, especially the more the knowledge is specialized. So I would say it's probably the primary driver is a change in the economy, but then these businesses do have just very attractive fundamentals based on our investment philosophy.
And any new companies that you're particularly excited about that you've had the opportunity to get into with the most recent sort of sell-off that you are willing to share with us?
Well, I can share that we've increased our position in Nestle recently. That's when you drink your San Pellegrino or your Perrier or eat your Kit Kat or your ice cream, drink your Nespresso at the office. So please do drink more because you are actively supporting the portfolio by doing that. Nestle is a consumer goods company, pretty stable. They're based in Switzerland, but 99% of the revenues is from outside Switzerland. It's a truly global company, food. So that's one that we used to own in the past and had added again and have increased.
And being in Calgary, I'm sure you're consistently being asked about resource exposure, because I'm sure every other asset manager in Calgary, probably that's all they have. With the current sell-off from the price of oil, has that given any opportunity for any resource names that you've have become attractive?
Yeah, to rewind a bit, I mean, that's sort of the story of Moore over the last 20 years, right? We've been of the opinion, well, way before I joined, Jim and the others have been of the opinion that Canadians probably rely too much on the domestic equity market. And that's why we, started marketing our international product, which we have since 1987, more actively, and why we launched the global funds more than 10 years ago, to allow Canadians to diversify away, their retirement savings, at least from an economy that's particularly here in Western Canada, not that diversified. So, our whole view on the energy industry comes from the idea that as a firm, our mission has been to help Canadians diversify away from this. And then with our philosophy, wealth creating businesses, usually what we call the primary sectors, so, mining, gold, oil, all that stuff, usually doesn't lend itself to great returns on capital and competitive advantages. I mean, the things are called commodity for reasons because they are commodities. So by definition, there's no competitive advantage. So in the global portfolio, we have no direct oil and gas or mining exposure. We had a tiny one until January, but very tiny. It was like below 1%, but we sold that because
So I've got a client that was just asking what the relationship is between Manulife and Mower. Now, from my perspective, Mower is one of the many managers that we utilize to help manage part of our portfolios. Now, Manulife also, though, is a distributor essentially of some of the Mower mandates, meaning they're a third-party manager that Manulife has branded their own funds. So do you have anything to add to that, Christian?
Well, yeah, we're a boutique asset manager. We focus on managing the funds, and on the distribution side, we have a few large institutional clients, or many large institutional clients, and the retail business is just one that distribution channel that Manulife had was one we didn't have, 13, 14 years ago when the contract was drawn up between Manulife and Moore. And so the deal was, Manulife can have our, can sort of rebrand some of our funds as Manulife funds and then distribute them through their channels. So it's a partnership, if you will. Part of our distribution just goes through Manulife. Yeah,
and I have to say, I've worked at Manulife in different divisions, and I'm going to say that probably is almost a 20-year relationship at this point.
Yeah.
Because I'm pretty sure it, back even when Manulife was Elliott and Page Mutual Funds, I think you guys were a third-party manager for them, and that was in the early 2000s. So.
Mm.
Well, with that, I think those are all the questions we have. I think we'll wrap up. Christian, is there anything else you'd like to leave with us, or are you pretty comfortable with where we're at?
No, I think that's the important thing to know about more, right? We're owners of our business. So we're going to be around here for a long time. We have to make our clients happy because we can't jump ship like if we worked for a big financial institution. I think that ownership, that long-term tie to the firm and to our clients, that really makes a difference because it influences how we think and how we act. And I think everything else flows from that. Like we own the business, therefore we want clients to be happy, be here for the long run, and we're trying to set up things in a way that they are as resilient as we can get them. And we're not always we're not going to get everything right, but we have the right incentives to at least try, and so far it's worked okay. And we'll continue to do our best.
Well, thank you. And I will say that if an individual is looking for certain criteria that historically makes a big difference in the long-term track record of any portfolio management shop, ownership is a big piece in that. And Christian sort of alluding to that, where there's sometimes at some firms where a money manager is simply hired to manage a certain style because that's how they were hired to do it, versus if that portfolio manager has a significant amount of their own personal wealth, and a lot of times that means they're privately held businesses, over a long-term period of time, they historically outperform. There are other criteria such as something called active share, which I think I've talked about as well. Active share is how different you are from the index. So if you are 100% active share, that means you'd have 0 stocks that were in the index. If you were 0 active share, that means you were an index fund, meaning you just bought, the S&P 500 index. So there are 8 different criteria that we actually look at. I can talk more about those on another day. But with this, I'd like to thank Christian for his time and everybody for attending. I hope you got a lot of value out of that. And if there's any follow-up questions, please feel welcome to reach out to us. So thanks very much, Christian, again for coming, and everyone have a great day.
Pleasure. Thank you. Bye.